Good morning. My name is Frank Grinnell. I've been advising professional money managers and investing in the stock market for over 20 years. It serves as my day job, but most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we actively manage dynamic stock and ETF models for financial professionals and their clients, as well as individual investors. If you want to learn more about what we do, send me a note, frank@grinnellcapital.com. You can also find more of my insights on Twitter @GrinnellFrank. And now, today's Street Views. All right, good morning. We are back after spending a lot of last week in Denver at Schwab Impact. Had a great time, got some good content, saw some old friends, all that good stuff. But back to work today. I'll give you some observations, mostly from Jeff Gunlock from Schwab, who's always good to listen to. But for right now, looking at the markets, the 50-day moving averages are really taking center stage here for us. On both the dollar as measured by UUP and the S&P 500 itself, the dollar is going to open just below its 50-day this morning. It's been flirting with that 50-day for a while. It looks like the dollar is trying to make lower highs, which would be great and constructive for the market in general. But watch that UUP today if it tries to regain that 50 after the gap down this morning. On the S&P 500, it's just below its 50-day moving average. It had traded above, and gave it up after post-Fed last week, and now trying to make another move back above that 50 days. So really the technicals are holding a lot of the short-term action, in my opinion, right now. So Gunlock at the conference had a few interesting things. Number one, and he spoke to the whole group after the on the Fed day, about like 1 hour after the Fed made its decision. So 10-year yield, he think, has peaked. Sees value in that intermediate section of the Treasury curve. Doesn't see the U.S. escaping a hard landing. Thinks that's it's going to be around May of next year, I believe, is what he was thinking, or potentially even second half. But nevertheless, does not think the U.S. is going to escape a hard landing. Does see a recession. And then my favorite comment he gave was, "Housing is doomed." He was just asked about housing. That was kind of his first off-the-cuff reaction to it. Housing is doomed. Thought that was interesting. I think he's, largely from a general price perspective and sales activity. And it does seem like I've heard anecdotally there was a builder around Denver who said he's never seen sales just stop before. So things look to be softening for sure in the housing space. Those who think that 23 can be a flat to up year in terms of pricing, I think is a little bit misguided. Earnings season in general, pleasantly surprised with the industrial companies. Honeywell, Roper, Johnson Controls are a few that reported decent quarters, high quality guide, strong cash flows. Need to tune into a couple earnings reports still, but in general, really constructive. We own all three of those: Honeywell, Roper, Johnson Controls. We will potentially be adding on pullbacks here, but again, I want to do a little more work on the calls and see if that's something we really want to get convicted on or not, because the risk here is they simply don't have the weakness that they're going to experience going into 23. They don't see it yet. That's the risk. So we will see. Got to take a closer examination there. But the commentary nevertheless was very constructive. Honeywell said they're looking to do a large acquisition, so they are completely on offense right now. Very interesting, I thought. CPI coming out on Thursday. It feels like the goods component of it is rolling over, but services component still remains stubbornly elevated. Hopefully we see a 7 handle on CPI. That would at least be going in the right direction, though still quite elevated. And then I can't help but to notice the FOMO going on when it comes to semis out there. Semi Capital's had a pretty good run already. That's our preference over semiconductors for the cycle, but we're essentially we've owned Air Test for a while, and that's a little bit of a unique situation. but going to keep an eye on that. Hesitant to join the party. What does look interesting to us is still oil service on pullbacks. Halliburton, Schlumberger, OIH all look good, and I think they've got a really good runway in front of them for the rest of going into 23 and potentially 24. So that is it. Have an awesome day. We'll be back to you tomorrow.
And now for some important disclosures. Grinnell Capital is a state-registered investment advisor. Services offered by Grinnell Capital can only be offered in certain states where Grinnell Capital is registered or meets required exemptions. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisorinfo.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be construed at the provision of personalized advice and is subject to change without notice. This material should not be considered as a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility therefore. This podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve strong relative and risk-adjusted returns, primarily by investing and trading in securities issued by companies that focus on the global information, technology, consumer, healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth, an abundance of both new and maturing product cycles, a high degree of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange-traded fund, ETF, strategy with an investment objective similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some downside protection in the event of significant market stress through investments in ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, grinnellcapital.com.